All right, I believe we are live, and it is almost time to get going. We're on a call with some clients and almost came up to the wire here, but we got it sorted. All right, so let's. No, it says pre-live. Uh-oh, not starting. Okay, it says live over there. Let's see what's going on. Oh, there we go. I'm live. See my big face? Okay. So we are going over 5 tactics to saving $32,846 on your income taxes in 2024. Now let's see if everything comes up correctly. Loading, loading. There we go. Get rid of some bookmarks. All right. So this is a case study of a client that we were working with, that we are working with, and we're just going to step through all the different things of how to actually do this. So this is going to be very tactical, hence the name 5 Tactics to saving this kind of money on your 2024 taxes. So if you have seen some of our previous things on our 4-step method, it's going to be a lot of those. It's going to be, how this actually gets implemented into somebody's tax situation, and then how does that tax situation evolve over these strategies, and what are the moving parts and all this kind of stuff. So let's go ahead and dive into it. All right, I'll give you a little bit about my story. Uh, so in the year 2000, in the uh, in the I was about to graduate from college, and I was interning out in Texas, working for AMD. And I happened to be there when the AMD had beaten Intel. They both make microchips for computers. So AMD beat Intel to releasing the first 1 GHz processor, which was a big deal, and everybody was super excited. The stock was going up, and this was during the tech boom in the spring of 2000. And so at the end of that term, we had a little award ceremony for the company, and then the last one was, I'm going to call him Bob because I always call everybody Bob, and the he got an award from the company because uh, during crunch time when they were launching this product, he had a 2-week European vacation booked and paid for with his family, and he decided to cancel all that so he could come in and work. And isn't he such a great guy? He's a real company man. Let's give him a hand. All that kind of stuff. So it was right then that I realized that this is not going to work for me because that is not going to be the lifestyle that I wanted. I want a little bit more work-life balance. And that was a fairly new concept back then. I mean, everybody talks about it now, but this was, 25 years ago. So at that point, I started on my entrepreneurial journey, and I did a bunch of stuff, some good, some bad. And then in 2007, I started getting letters from the IRS saying that I owed them $1.3 million. So, like most people, I stuck my head in the sand and I ignored it. So, if you haven't had this happen to you, what happens is first you get letters and you get a letter every month or so. And then if you ignore those, you start getting certified mail. And if you ignore those, you start getting phone calls. And if you ignore those, then they'll start going after whatever they can find. And in my case, I didn't have any big bank accounts. I didn't own a house. I didn't have boats or anything. So what they could go after was my paycheck, and they garnished my paycheck. And at that point, I could no longer pay rent because that was during one of my low periods for sure. So I ended up casting around trying to fix my own problems. And by 2011, I had hooked up with a former Wall Street tax attorney, and he had helped me fix my problems, and I helped him fix his business problems. And then we went off to grow his business significantly over the next few years. And I ended up getting trained in this Wall Street tax planning approach over the next, roughly 10 years. Uh, and over that time did, 50,000 tax returns, billions of dollars worth of revenue and, saving clients millions per year. So then in 2020, obviously the world stopped and I ended up going off on my own. And, my mission has always been to help the people in my tribe. And people in my tribe are all those people out there who can't hold a job, the solopreneurs, the independent contractors, the small business people. And, the mission is to help them get their quality of life back by saving on their taxes because, taxes are actually a pretty big deal. So I love this quote, Tony Robbins, quality of our questions determines the quality of our life. And I want the quality of our lives, mine, yours, everybody's, to be as high as possible. So, the question that always occurs to me is like, what is the root problem with overpaying on your taxes? And the answer to that is you're wasting 20% of your life. And I mean wasting. So 74 days is 20%. So if you're just putting numbers on it, if you're taking your tax rate from 35% to 15%, then that's 20% of your income, which I'm going to assume that you spend working during the year to obtain. That is money that you were handing over to the government that you didn't have to. And for however many years you've been doing that, that's 74 days each and every year that you are working for the government and not for yourself, not for your family, not for, whatever you wanted to spend your money on. And so that's really the core problem, the root problem of overpaying. And so, what Tax Sherpa does is we look at your situation and we've got a four-step process. There's the survey, the route, the trek, and the compass check. So the survey is where we look at your individual situation. We figure out what's going on in your tax world, your filing status, your family situation, your jobs, your other income, and we take all that and that turns into the route. And the route is the map. It's going from where you are now to where you want to be. How do you want to save that 20% of your life? And what are the structures and entities and tax strategies that we need to put into place in order to achieve that? Once you have the map, once you have the route, then the trek is where the work gets started. And that's where we start implementing all these things and helping, some of the stuff, obviously we do, some of the stuff, we have to coach you through. But we're your Sherpas, we're your guides. We're helping you get from point A to point B. And then along the way, you got to check your compass. You got to figure out where you are. Are we going in the right path? Have things changed? Have conditions changed? Did a storm come in and, maybe, your source of income evaporated or, the whole world shut down like we saw in 2020 or, this, that, and the other. Everything changes. We know that. So we always have to consistently check if we're on the right path as things evolve. So that's how we do things. And, you know, I want every single person. So, I happen to be reading the White House fact sheet that they published the other day about the 2025 budget proposal that Biden put out. And there's a big section on tax in there. And I've got some videos that I'll be rolling out here. And basically, there's a lot about paying your fair share. So I don't know about you, but I think your fair share is pretty close to zero. That's that's just my opinion on it. I think you are going to spend your money better than the government. And even if you were to take it all to Vegas and put it on black, I still think that's a better use than to hand it over to the government, and let them do whatever they're going to do with it. Because once that money's in their pockets, it's there's no control essentially at that point. And you can look at your favorite listing of pork projects or funding this war that you think is immoral or uh, you know uh, or whatever policy that you disagree with. You know, nobody, I can guarantee you, there are zero people who actually agree with how every dollar is spent by the government, and that's at the federal level, at the state level, at the local level. So I want you to retain as much control as you can. So let's get into how all that actually works and do the 5 tactics. So this is a client we were working with, came to us last week, I think it was, and here's their situation. And this is going to be visually a fairly simple presentation because we got this. So this is before, and we're going to show you after, and, and it'll show you how it works. So we've got a husband and wife filer. They have 1040. They've got a W-2 of 150K coming in. He's got an LLC that's disregarded entity. There's that brings in about 270. There's a partner involved who's got about 130 of that 270, and the filer and spouse got about 140. There's three properties out there, and two of them are owned by an LLC, and one of them is owned individually. But the LLC is a disregarded entity, so it all gets filed on Schedule E of the tax return. And the net of all that is taxable income's 224K. Income tax on that is 40. Self-employment tax from this guy down here is 20K. State tax is 11. And so the total is 71,000. So that is what's that percentage? Let's see, 71 divided by 224. That's 32%. Okay, so pretty close to that 35 that I was talking about. And so that's before. That's what they came to us with. And so we went through their numbers and we started analyzing things. And here's what it looks like after. So we implement a few different elements, and the net shot, if you want to just get to the end here, taxable income drops from to 178. So 224 to 178. Income tax goes way down. Self-employment tax gets eliminated. State tax goes down somewhat. Total tax goes down to 38. So basically, we cut it in half. So 38 divided by 224 is 17. So we went from 32% to 17%. And let's see, 0.32 minus 0.17 is, okay, we didn't quite get 20% there. We got 15%. But still, that's 55 days of their lives that is able to be claimed for themselves, spent on whatever they want to do, whether that's reinvesting in their business or going on vacations or spending time with their families, whatever. That's time that they can put into their personal lives and getting their quality of life back. So over the next few minutes, we're going to go through how all this works and how we get from point A to point B. And so yeah, let's begin at the beginning. So the beginning, number one, is that if you have a W-2 from an outside job, that is whatever it's going to be. There are things you can do. You can maximize your 401k. You can put money into an IRA. But ever since the Trump tax reform, the Tax Cut and Jobs Act, basically all of the planning elements have moved over from, I mean, before there was some individual and some business. Now it's pretty much all business. So that's something to think about. And it's going to remain that way for at least the next couple of years. So a lot of the Tax Cut and Jobs Act provisions have a sunset in 2026. And because that was a 10-year time horizon, when Congress passes a new law, they always get it scored by the Congressional Budget Office, and they do a 10-year projection. And so that's why a lot of these things have 10-year lifetimes. Already, though, as we're getting close to the end of that 10 years, Congress is already starting to make moves where, maybe not, these things are actually going to sunset in the way that they had planned. So in the White House fact sheet that they just released the other day, they were talking about the child tax credit, among other things. But the child tax credit during COVID, they took that from $2,000 per kid up to $3,600 per kid. And if you remember, they started paying it out monthly for 6 months out of the year. And then you picked up the remainder on the tax return. And it just worked out that way because that's the time during which they were able to pass the legislation. So Biden wants to go back to the 3,600, and will that happen? Who knows? But the point here is that when Congress says, okay, in 10 years this thing will expire, well, the Congress 8 years from then can change their mind. So that's always just something you have to be aware of. But for now, most of the tax optimization things to do are on the business side. So like I said, W-2, if you want, max out your 401k, great, go for it. You could make an argument that, okay, we're saving $32,000 in taxes. I could take some of that 32 and put it into my 401k, and then my take-home equivalent is still better off. So that's definitely something that could be done. Um, and that's just going to depend on what your outlook is for, retirement savings and 401k plans in general as to whether that's worth doing. If I want to take, you know, uh, 20 of my 32, put it into a 401k, is that a trade that I want to make? And that's very subjective. And there's pros and cons. So, that's something that we can explore. In this case, we didn't build that in, but we certainly could. So that is one option that would actually, even increase the 32 that we're talking about here. Um, Over here, so if we go back to the before, he had this LLC. It was bringing in revenue, and then he was paying out this partner, and they were doing all kinds of complicated bookkeeping sort of stuff where they were getting commissions, and it's like, oh, this commission's for my partner, this one's for me, and they got to separate everything. So not only um, is that a nightmare from just a tracking standpoint, but also I've seen it many times where somebody ends up feeling cheated. And it could be either one, right? It could be the guy who's out here on the side saying, well, I feel like I should be getting more. Or it could be, our client over here saying, it's like, well, I'm paying this guy all this money, but I don't feel like he's doing, whatever he should be doing. And I think I'm giving him too much. So there's lots of opportunity for bad feelings, which we want to avoid if we can. So what they should be doing, and what we are in the process of building, is they make a new company, and this is going to be a partnership, and it's going to file a 1065 tax return, and they will each own their interest in that partnership through an S corporation. And if you've seen my presentation on partnership issues, that is generally going to be the structure that you're going to want as far as the ownership of the operating company. So this company is going to have revenue, it's going to have expenses, and it's going to file a very simple tax return. And the money at the end of that, gets distributed on a, monthly or quarterly basis, whatever you want to do. And that's going to be split, whatever your percentages are. So the cash flow part on a net basis remains the same as in the before situation, but it's just much cleaner, and we don't have any opportunity for argumentation. And so what happens a lot of times in partnerships is, even if they don't feel like they're getting cheated, um, what happens a lot of times is, during different years, different partners will have different tax goals. And it could be one person wants to buy a house. It could be one person is getting a divorce. It could be all kinds of things. And so, you know, when you have just the single entity, like in the before situation, then you have to have this argument right here. They say, well, I want to file it this way. Oh, I want to file it that way. I think we should expense this computer asset. Oh, I think we should capitalize it and spread it out over time. All these different decisions to be made on a tax basis, they all have different impacts on what the ending net income is for the year. And if you don't agree on the goal on a tax side, then it just leads to all sorts of arguments and hurt feelings. On the other hand, if you own it through your own companies, then this entity right here just files a very simple tax return. The money gets spread to the owner owning companies, and then you can optimize your tax situation at that level. And it gives you a lot more flexibility. It is a little bit more complex, but it gives you a lot more flexibility as far as what you want your portion of the joint venture to end up being, as far as the net impact on your year. So that's the general situation that we want to put into place. And it simplifies the bookkeeping, and it prevents the arguments, and it's just a great way to go. Once you have an S corp, though, there's other stuff to do. So if you've seen the our usual four-step um, webinar, then we put into place all of the strategies that we talked about. So the Augusta right here, I'm just giving you ballpark numbers here. These aren't exacts, but the Augusta strategy is where you have your management meetings. So every business needs to have management meetings because there are multiple functions in any business. So function number one is providing the product or service that you are offering to the world. Another function is administrative work. Another function is sales and marketing. Another function is compliance work, depending on what you're doing. Um, but arguably the most important function is actually the management function of saying, where do we want to take this business? What do we want to do over the next month, over the next quarter, over the next year? Where do we want to increase our activity? Where do we want to decrease our activity? And so we we encourage all our clients to have those meetings with themselves, because the problem with small business is that it's small. So, you end up being chief cook and bottle washer. So it's very, very easy to fall into the trap of just doing the thing day in and day out. On the other hand, every public company, that's on a stock exchange somewhere, they are required by law, and even some that are not public are required to file annual and quarterly reports. And so, that necessarily dictates that they are looking at the business on a macro level and pulling the different levers of, however they want to do it in order to shape the future of that business. As a small business person or as a solopreneur or as an independent contractor, you need to be doing the same thing. And that's just good business practice. A lot of the ways that I phrase it is that in order to get the business benefits, you have to act like a business. And too many small business people or independent contractors don't. They just wake up and they say, I'm doing the thing, and that's it. There's money in the account, great. There's not money in the account, crap. That's kind of the beginning and ending of their planning. So by implementing a meeting strategy, yeah, we get a tax deduction out of it because there's under Section 280, there's an exclusion for if you rent out your primary residence for 14 days or less. You get to exclude that income from your taxable income. Um, and so we take advantage of that by finding comparable uh, meeting space rental rates and creating a rental agreement between your company and yourself. And there's T's to cross and I's to dot when you do all this, but effectively, not only are you getting a tax deduction out of it, but you're going to run your business better. And when you're talking about the tax code, the whole thing you have to keep in mind is that it's a series of carrots and sticks. And the sticks are the things Congress does not want you to do, and the carrots are the things that Congress does want you to do. And essentially, the short version of the entire tax code is that the government wants you to improve and increase business activity in the country in order to support the economy overall. That's kind of it. So if you are doing things in pursuit of that, then you get all kinds of benefits. And if you are not, then a lot of times you don't. So that's kind of the context you always have to be thinking about. So a lot of people end up asking me, it's like, oh, I'm getting a divorce. Can I deduct my legal fees? I'm like, oh, no, you can't. But if you are suing somebody because of, going after income, like somebody did, like a vendor didn't pay you or something like that, customer didn't pay you, or you paid a vendor and they gave you a shoddy product and you're trying to sue to get it back, those legal fees are deductible because it's in the pursuit of income. Whereas, a divorce is just trying to protect what you already have, essentially, or argue over who gets the kids on weekends. So that is not in the pursuit of income. So, even though it might even be the same lawyer, and it's the same type of expense, one's deductible, one's not, because of the intent behind it. So, in having the management meetings, your intent is to run a better business, and if you're doing this right, you should. So we have a whole template of how to run those management meetings, and basically, the idea is that you are going to, well, one, you got to get your books done. Um, you shouldn't be doing your books yourself because you're doing it wrong and you're not doing it on time. So so outsource it. We'll be happy to help you, but there's other people out there too. And get your books done on in a timely basis at the beginning of every month. Usually you want to see the books done by the 10th, roughly. Weekends, here or there, sometimes interfere, maybe it's 12th, whatever. In this month, the 10th was on a Sunday. So, take it to the 11th or the 12th, which is today. Either that's fine. Then mid-month, you have your books ready to go. And then you want to actually look at them. I know this sounds crazy, looking at your books, but in order to run your business as a manager, you got to know what's going on. And your books tell the story of what has happened. So many people look at bookkeeping as a cost, right? Yeah, I gotta pay somebody to do it. I have to, or I have to spend time doing it myself, but whatever. That's all expenditure, of effort and money. Instead, you gotta look at it as a planning tool. So you're investing this time and this money into running the better business, making more money, and eventually paying more taxes because you are making more money. So there is that. Um, and so you have your bookkeeping statements. There's the three primary statements. There's the profit and loss, there's the balance sheet, and the statement of cash flows. So uh, you know, I don't want to get into too much about how the solopreneur type person tends to evolve through those statements, because you start off on the cash flow statement is, do I have more money this month than I did last month? Then you kind of move to the profit and loss and try to look at on an accounting basis how much money is being made, and then eventually you end up managing the balance sheet of, are you building assets or are you not? So that's a little bit far afield, but that's just a side note. So in your meeting though, you're gonna take your profit and loss statement from the most recent month, and you're going to take the profit and loss statement from the month before. So, we just finished February, so you look at February and January. And this is critical, where you are not just looking at a single snapshot, you're looking at a series of snapshots, which creates a movie, right? Or an animation, however you want to think about it. And it's that evolution over time that you're really trying to figure out. So you look at February compared to January. What happened to revenue? Did it go up? Did it go down? Did it go sideways? Take note of that, and then write down why. Why did it go up? Why did it go down? And then you want to look at your expenses. Did those go up? Did those go down? Did they stay the same? Again, why? Write it down. Uh, and then I also encourage people to take a look at large expenses. So, typically I'll say anything over $1,000 is a large expense, but it's going to depend on your business. Some are higher, some are lower. Um, and you want to figure out, okay, are these large expenses, are they one-time expenses or are they recurring? Um, is it something that I could have done better or cheaper or faster? Did I really need to do this at all? So I paid, so and so for this marketing package. Did it work? Was it a total waste of money? All these kinds of questions you want to be asking yourself. I think we're doing this every month. You want to be asking yourself, was the money I spent on all these things worthwhile? Um, and then so we do that January versus February. But then we also want to do it on a quarter-over-quarter basis. So we're in Q1 of 24. How did that compare to Q4 of 23? And if you're early on in the quarter, like you just did January, then it's a little bit harder to compare. But as you get closer to month 2 and month 3, then there's more information there. So that is another level of comparison. And then you also want to do a year to date versus year to date. And we say, okay, we have now completed January and February of 2024. How does that compare to January and February of 2023? And, so do the same comparisons, revenue, expenses, large expenses, and kind of understand the trajectory of what is happening in your business. And if you just do that, then you'll be ahead of 90% of your competition, because they don't, and you'll be a better business person and making more money for it. And we get a tax deduction along the way for this rental of your primary residence. So at those meetings, another thing that you do is you're going to do your reimbursements, and that's the accountable plan in the middle there. And there are a lot of expenses that solopreneurs and business people are spending personally that should be elevated into the business layer in order to, because of its business use of those things. And every entrepreneur does this because that's just what entrepreneurs do. I don't want to say everything, but almost everything has some kind of business connection. It might be, how you use your car. It might be how you travel. It might be maybe you put into place a medical expense reimbursement plan. It could be all kinds of things. So that is so typically we'll see numbers, 10, 15, $20,000 over the course of the year that we can capture into the business layer and create those expenses. And those are not taxable income because they're reimbursements. Just like if you work for a large company and you go on a business trip and you buy whatever it is, And then you go back to home office and you give them your receipts and they reimburse you. Not taxable income because it's a reimbursement of money that you spent to make you whole. Just in the same way, insurance proceeds are not taxable because they're making you whole. They're covering you for a loss that you've already incurred. So that is another great tactic that we use a lot of because you know the it's teasing apart the business from the personal. And if you're doing good accounting, you should be separating the business from the personal and make sure the business is allocated to the business and the personal is allocated to the personal, which sounds straightforward, but a lot of people have trouble with it. Um, Another element that we put into place here for this particular client is that he had this LLC that owned two of his properties. And this this LLC, we're going to spin it out instead of filing it as disregarded entities included on the personal tax return. We're going to spin it out uh, into its own entity as a 1065 partnership, and we're putting the kids on payroll. So this case, we've got three kids that are appropriate ages, and there are fantastic tax benefits to putting kids on payroll. Some of them are that between the ages basically of 8 and 17, you can pay your kids and they'll be exempt from Social Security tax, Medicare tax, unemployment tax. And if you pay them less than the standard deduction for that particular year, which this year is about $14,000, then they are not subject to any income tax. So you could potentially pay your kid about $14,000 and it becomes a deduction to the company and it is not taxable to them. So it's just a deduction. And so that's fantastic. It lowers your tax burden. If you're at what did we say before? 32%, uh, basically average tax bracket. So if you take 32% of that 14,000, that is a cash savings of 4,500 bucks. And so fantastic, right? But there's more layers to it. There's always more. So, it's a great tax deduction. It's also a great teaching opportunity for your kids. Uh, so many kids, myself included, learn nothing about money as they're growing up, either because they're just insulated from it or the parents don't want to talk about it or whatever. That I think is a mistake. So by creating this stream of income for them, uh, you have the opportunity to start teaching them about money. So, okay, you made $100 by doing this work. So, what are you going to do with it? Are you going to put it in the bank? Are you going to save it? Are you going to invest it? Are you going to blow it on rollerblades? Whatever the kids are buying these days. My my 10-year-old wants to buy some rollerblades, but and that was an example. She found these pink rollerblades on Amazon, and they were $39.99. And I said, great, let's talk about sales tax because she had like $36. She's like, I only need $3 more. And I said, okay, well, once we add it to our cart, and you'll see it's no longer $39.99. It's 43, whatever it was, because of sales tax. What's sales tax? Well, it's a fee you have to pay to the government in order to buy stuff. Um, and she said, that's not fair. And I said, you're right. It's not fair. But that, those kinds of lessons, as far as learning how money works, are critical for long-term I don't want to say survivability, but I mean people will survive, but long-term monetary health, let's say. So you get to start to have those conversations. Also, every parent in the world is spending giant amounts of money on their kids. And so now instead of coming out of your account or your card or whatever, it comes out of their account. And, when when they start to see money in their account going down, or if you have cash, however you want to do it, um, they become very frugal. So it's like, oh, I can't afford that. So that's a way to overall save, just because your kids will be spending less than you might have spent on them anyways. So that's another layer. Now they have a W-2, they have earned income. You can open IRAs. It could be traditional IRA, it could be Roth IRA. Most people will prefer the Roth, even though you don't get a current year tax deduction, but it grows tax free. And when you take it out, you don't have to pay any tax on it, which is fantastic. So, you know, the average retirement time horizon is 20 years. And well, 25 maybe. So, and that's contrary to what you'll read in a lot of books, because they'll say, well, you graduate college, assuming you go to college at 22 or whatever, you get your first job, you start putting money away, you put it like there's all these statistics where it's like if you put in money for 10 years at the start, uh, and then stop and then never touch it again and let it grow versus you wait 10 years and then you put in way more and for the rest of your life, then you still never catch up to starting early. And there's some truth to that. The issue comes in that um, people often sabotage themselves when it comes to retirement accounts because either they don't put enough in or they don't leave it alone. And those are kind of the two things. If you put enough in and you leave it alone and wait for retirement, then the system does kind of work, or it has historically at least. Um, but I see so many people who end up cashing out their 401ks or whatever when they get, maybe somebody gets sick, maybe they get laid off. Maybe I've seen people like, I want to redo my kitchen, so I'm going to cash out my 401k. It's like, just please don't. But people do, and so they don't leave it alone, and they don't allow it to grow over time. So, and then there's the natural inclination that 22-year-olds are not serious about retirement. It's just the nature of being 22. So, most people start to get serious around 35, and then they want to retire early at 60, let's say. So that's it's 25 years. And a lot of people don't even get started till 45, and then 45 to 65 is 20 years. So that's kind of like the real life scenario of what people are working with a time horizon. Um, on the other hand, if you have a kid who's 12 and you have a lot more control over kind of what they do with their money, and you can say, okay, we're opening an IRA and you're putting this money into it. So you got 4,500 bucks in your pocket for setting up this whole structure. And now you're taking 6, 7 grand and putting that into, let's say, a Roth IRA. And now you're going, instead of going from 35 or 40 or 45 to retirement, you're going from 12 to retirement. Then you have so much more time with which the market can work in your favor. And if you do all the financial planner type math where they say, well, the stock market has returned on average 8.8% in terms of compound annual growth rate since 1910 or whatever the number is, then and you run that out over, what's 12 to 65? Is that 53 years? Right? So, if you compound that out 53 times, then, it becomes an enormous amount of money. In fact, let me just do that math real quick. So let's just say 8% raised to the 53rd power. That's a 59 times growth. So if you put in $6,000 today at age 12, and we could actually do more, we can do 7,000. But that one contribution, assuming historical averages remain consistent, blah, 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 that turns into 355,000 in the 53 years, which is a lot of money. And then you have next year, which will be another 6,000, but it will grow 52 years. And then the year after that, another 6,000 at 51 years. And you add all those up, it ends up being a giant amount of money. And yeah, there is inflation, and that's going to eat away at the value, but the market returns are greater than the inflation cost, so it tends to work out. And that's because the market is operating businesses, and they're only going to continue to be in operation if they continue to charge more than the cost of capital. So there is all that. So in our client's case here, we're going to put the kids on payroll, and it has to be into a partnership structure just because that's how the rules are written. So it can't be in the S corp. But then we have the question of what are the kids going to do, because they have to do actual work. That's the thing with all these tax strategies. You got to actually do the thing that the rules say, because if and when the IRS asks, you have to be able to document the things that you're claiming on your tax returns. So, a tax return, what a tax return is you telling the government kind of what happened that year. And there was all these flows of money, but what does that actually mean? Um, so I like to use the example a lot. It's like $100 shows up in your bank account. What is that? And there is no one answer, right? Maybe it's income. Maybe you sold something. Maybe it's from a W-2 job that you have. Um, but maybe it isn't. Maybe it's a gift from somebody. You got money for your birthday. Congratulations. You got $100. That's tax free to you. And if it's under $16,000, then it's the person who giving the gift doesn't have to report it on a gift tax return. Um, Maybe it is your friend. You went out to dinner last night, and you covered the bill, and you're being reimbursed. Again, reimbursements are not income. Maybe it's a capital gain of some sort. Maybe you had bought something and you've bought it for 50, you sold it for 100. $100 shows up in your account, but only 50 of it is taxable. And it was over a year, so it's long-term capital gain. So, the tax return is the description of all the different things that happened to the government, saying, okay, here's how the year went with all these different things. And sometimes they'll ask, it's like, okay, well, you told us this thing happened, show us your proof. And most of the time, when the IRS asks for proof, they just never get a response. And I understand. I was one of those people. If you go back to my story, I spent 4 years with my head in the sand. Um, but you know, I want you to avoid that kind of stress in your life. So you just do things right on the front end. Like so with the kids on payroll, actually have them do a job, have a timesheet, have a market-based compensation package. So like with my daughter, she's 10. She does office work. She opens my mail, she scans it, she does shredding, stuff like that. And she's not full time by any means, but the time that she does work, I look up in my local market how much people doing that kind of job make, and I pay her that, on the lower end, obviously. But especially with today's technology, I encourage a lot of people to put their kids on their social media. So have them do your posts, have them do your DMs, have them do your research on your competition. Look for joint venture partners or people in connected but not competing industries. So like if you're a chiropractor, you might want to talk to a nutritionist. That'd be a complementary kind of business that is not a direct competitor. And maybe you want to do something together, or maybe you just want to comment on their posts so that they have more organic interaction on whatever your social media platform you like. So they can edit your videos. They can do a lot. They can do it all from their phones. So that's real work that has real value in the marketplace and creates a great tax deduction for yourself. So we're putting the kids on payroll for that. And if you have a real estate company like we have here, it might be having them do the billables and following up with contractors and checking up with the management companies and all the kind of uh, administrative sort of things that need to be done, they can do. And then you're teaching them job skills, and you're teaching them show up on time, and all these kinds of things are helpful to them over the long term. And it's a tax deduction for you, and you can put into place retirement savings for them to put them light years ahead of their peers. So it's all to the good. And after we do all that, we are reducing the net income basically by half in this case. So the money that flows through from an S corporation is different from a Schedule C, and it's different because of self-employment tax. So profits from an S corp are do not carry self-employment tax consequences. Profits from partnerships and Schedule Cs do. And that's kind of a whole rabbit hole that I'm not going to go down right now, as far as how much and when and all that kind of stuff. But um, you do have to be careful with taking distributions from S corps, as far as distributions versus salary, and which money's first and which money's second, all those kinds of things. But that's a bit beyond just the short time we have together tonight. But because of this filer situation, the salary is not as critical as in other situations, just because there's other W-2s and there's already capping out on Social Security and things like that. So it gets complicated. And the great thing about pass-through income, though, from whether it's an S corp or a Schedule C or 1065, is the qualified business income deduction. So this was another thing created by the Trump tax reform, the Tax Cut and Jobs Act. And what happens with the QBI is that your pass-through income has up to a 20% tax break. So let's just say you have $100,000 um, worth of pass-through income. Depending on the numbers, you might only pay tax on 80 of it. So that 20,000 becomes tax-free, income tax-free, not necessarily self-employment tax-free if it's from a self-employment source. So um, once you get above a threshold, and that threshold is going to depend on your filing status, whether you're single, head of household, married filing separate, married filing joint, then the flat 20% break starts to be phased out, and the test that comes in is wages paid by that entity. There's a second test if there's assets owned by that company. So that's primarily for real estate companies. Um, but for a service-based company where it's basically either there's no you know hundreds of thousands or millions of dollars worth of assets. Typically, the test becomes between wages and then the 20% of net profit on the pass through. So that all gets to be tested against each other, and there's work to do there in order to make sure that you are maximizing your benefit there. But it's the QBI can be a huge savings depending on the numbers that you have, and those all those elements put together that we just went over are five tactics. They're five different things, and they're not the only things, right? There's a million tax strategies out there. There's a million tactics. Like we could have looked into cost segregation on the real estate and whether one or the other of the spouses could qualify as active or material or professional participation. Like I said earlier on the W-2s, we could look at increasing the retirement contributions. So there's many different ways to affect things, but these five have a huge swing in this taxpayer's case. So basically, we cut down taxable income by implementing the S corp strategy, the payroll, the reimbursements, and the monthly meetings, and the joint venture restructuring. And then we were able to take all that, put it together, reduce taxable income, reduce self-employment tax, reduce the resulting federal income tax, and reduce the state income tax. And then the net difference goes from, 70, what was it? $71,000 worth of total tax down to 38.7 worth of tax. And so I forget 71,660 minus 38,698. Yeah, 32 962 there. So then the question becomes, you remember the quality of our questions determines the quality of our life. I have an extra $32,000. I'm rounding down even 32. And that, what do I do with that? Right. So option one, I work the exact same and take that, and what was it, 55 days in this case? Take that 55 days and just hang out with my family and go on vacation or whatever. That's certainly an option. But most people who are entrepreneurial are much more driven than that. And so what they end up doing is they reinvest that time and reinvest that money into their business and grow it larger, faster. So that's probably what this guy's going to do. Just from, the conversations that we've had with him, he wants more, better, and bigger. And, that is kind of going back to the whole carrot and stick approach that Congress has, is like they want more economic activity. That's why all these benefits are there for the business owners. So, you take that 32,000, maybe that becomes hiring a new person. Maybe that becomes a new marketing initiative. Maybe that becomes I get some additional training or try out these software tools or whatever to increase my productivity. Who knows what? I mean, the world is infinite in that kind of regard, that, we have so many options to which we can deploy resources, but you need the time and you need the capital. So by optimizing your tax situation, you are saving yourself the time because you are now no longer spending that time working in order to pay the government, and you're creating the capital because you're no longer paying it to the government. And so that gives you the bandwidth with which to do all these additional things. So that's mostly what we see with our clients. They take all these advantages and just, plow it back in. And, I do recommend stopping and smelling the roses sometimes. I'm a big fan of the profit first methodology. That's a book by Mike Michalowicz, and there's many other versions of it these days. At one point, I was a profit first professional, but then I decided I didn't want to pay them anymore because it just wasn't needed. But basically, the profit first method, money comes into your deposit account, and then you spread it out to usually four other accounts. You have your profit account, and we do that first because it's profit first. You have your owner compensation account, you have your tax savings account, and then you have your operational expenses account. And depending on your revenues, there's kind of different buckets as far as, what percentage goes to what. But the profit account is usually, we want to see that at least 5% of your revenue being reserved just for profit. And the rule is every quarter, you need to take that profit, take that money out, and blow it on something. It's not for saving, it's not for investing, it's not for growing your business. It's just for enjoying life. So, stop and smell the roses sometimes. Don't get too burnt out on work. I have been there. I worked 100-hour weeks for a decade and ruined my health as a result of it. So don't do that. So take that time at least once a quarter. Do something. Take the kids out for ice cream or whatever it is. So, um, so that is kind of the short version of what it is that we do. So we put these plans into place for our clients. So this is a rough version of this client's route. And we will refine this over time as we dive deeper into these numbers as far as, fine tuning exactly what numbers are going to go where. Because, nobody makes exactly $270,000. Nobody makes exactly $150,000. Nothing costs exactly $20,000. But, these are kind of ballparks based on the numbers that we're working with. And as we talk to these clients more and more, as we do our compass checks, we get deeper and deeper into how the year is actually playing out on a dollar for dollar basis. And then, by the end of the year, obviously we have a full year's worth of history and we can dial in exactly how much the strategies save. But this is where we start. So if all that makes sense to you, I will say you don't even have to talk to us to do this. You can do it yourself. You can go to taxsherpa.com/templates. And it's actually a hidden link. You can't get, if you just go to taxsherpa.com, you can book an appointment to talk to one of our tax experts. But if you want the DIY version, you go to taxsherpa.com/templates, and you can actually buy the uh, the same planning template that we use internally, along with video guides of how to fill everything out, along with a business base camp tax guide as far as how the whole structure works and what to do and why. And you also get a tax filing checklist to avoid red flags that I wrote. There are a lot of things, different issues that pop up, and if you do this kind of thing wrong, which we see often enough, you're automatically going to cause yourself a problem. So avoid problems, avoid the red flags, and just go through the checklist, make sure you're not making any of these kinds of mistakes. And you can do all of that for the low cost of $7. And really, $7 is, we used to say it's the price of a cup of coffee. It's actually less than the price of a cup of coffee. And, McDonald's is, $20, a person these days. So, it's ridiculously cheap. And the reason it is that way is because, well, we are really busy. So there's 23 million businesses in America that are structured the wrong way. And uh, you know, obviously we cannot handle 23 million clients. It might be an interesting business if we did, but that's not in the near term growth plan. So um, so take the opportunity, go ahead and get the templates. I'll walk you through the whole thing, but by videos which are inside of the templates on each tab, and then you can go forth and do all this yourself, or at least have an idea, right? So I'll leave you with this kind of thought, where the tax business, like the business that Tax Sherpa is in, is fractured into two basic groups. So group number one are the people that I'm in, like mastermind and coaching things for tax and accounting businesses, and they're going after the large companies. We had one guy in our private Slack I think it was last week or the week before, it says, "Oh, I just got an engagement. It's $126,000," and everybody's, giving them the emoji claps and everything. And that's great. Very few businesses can actually afford to pay that. And obviously he's going to save them more than $126,000 in order to justify his fees. But that's what a lot of those people who do know what they're doing and do a reasonably good job at it. That's the kind of clients that they want. Businesses making millions a year, they can afford to pay these fees because they can save them the millions of dollars worth of or hundreds of thousands of dollars worth of tax. That's all great. On the other end of the spectrum, you have like the corner tax places, the strip malls and all that kind of stuff. And if you have nothing going on, like you just have a single job and you have two kids and that's it, then they'll do okay. They'll take your papers, they'll put them in the computer and they'll say, here you go. And that's kind of 95% of most tax people's experience filing tax returns, where they just hand over their papers, they get something back, they pay, they get a refund, whatever it is. That's kind of it. So the people in the middle, the people that I call my tribe, the ones that Tax Sherpa was founded for, are the ones in the middle getting screwed. So you can't afford $126,000 worth of tax planning fees because that doesn't make any sense. Just your numbers don't justify that. And so by default, you end up going to the corner tax place, or you do it yourself because you say, well, I can fill out a form. And you're missing out on all the planning opportunities that you could be doing because A, you don't know, B, they don't know. Uh, and, you know, you could be saving yourself like, and 20% is just an average. Some people more, some people less. 20% of your life, though, 74 days every year that you are spending working for the government that you could be working for yourself or going on vacation or spending time with your family or whatever else you want to do. So go ahead and go get the templates. Like I said, $7. If you can't afford it, then you're probably not in business. So, and it's a tax deductible expense. So, because it's a business expense. And, just go ahead and get yourself that and go through it, and you'll start to see your math on how your numbers work out. So, with that, next week we'll do another session. Go to taxsherpa.com/live. I have not updated that yet. I'll update that right after we get off the call here. And next week we'll be doing office hours, which is just an open Q&A. If you have questions, we got answers. And we got people who are asking questions constantly, amongst our client base. We always have plenty of questions to go over. I will tell you that today is March 12th. March 15th is the 1065 at 1120S due date. So it is what we call extension season. So if you have your own company and it's filing as a 1065 or an 1120S, make sure you get your extensions in. You do get a one-time freebie from the feds. You may or may not from the state. That's dependent state by state. But yeah, it's definitely worth doing. So I've been spending all day doing extensions, and I will continue to over the next couple of days. I'm about halfway done, so there is that. Meanwhile, the rest of our tax team is actually working on tax returns just to actually get them out the door. So that is it for this week. Those are 5 tax tactics to saving 32,000, whatever the number was, on your 2024 income taxes. Now, your numbers are obviously going to be different, but go through the planner, go through the templates, and that'll show you what your numbers are. Anyway, and I know Serena, I've been talking the whole time, but Serena's here.
Hi guys. It's okay. It's okay.
Say hi, and otherwise, we'll see you guys next week.
Alrighty.
All right, now I just got to figure out how to turn this off. There we go. Have a good one.
Yeah, right.